So we're going to get started and welcome you all today. My name is Elizabeth Aloni and I'm with Schneps Media. Schneps Media is the largest media company in New York metro area. We publish over 70 newspapers, magazines, websites, webinars, podcasts, and events throughout Queens, Brooklyn, the Bronx, Manhattan, Westchester, Long Island, and Philadelphia. Today, we're thrilled to bring to you Jay Mota, Financial Planner, CFP, who is going to be talking about investing in turbulent times. Very much an important topic right now. Thank you so much for joining us, Jay. Just unmute yourself so everyone can hear you're muted, Jay.
Thank you. The control bar disappears when I'm in my presentation mode, so I got it now. Thank you very much.
Terrific, terrific. Let me tell you a little bit about Jay. Jay is a certified financial planner, which is the highest designation in the industry. He's proudly married with 2 daughters and 2 sons. He was born and raised in the Bronx. After high school, he enlisted with the U.S. Marines and later again served the Army National Guard. His career in financial services began in 1997. He studied financial services at NYU and has a degree in business and the CFP certification. Athletically, he's run the New York City, Chicago, and Boston and Marine Corps marathons. It's his mission to be a resource, to create value in the lives of others. He's continuously working to improve himself so that he can help as many people as possible in all areas. He's disciplined and governed by his principles. His clients work with him because he takes the time to educate them about planning for their financial needs and concerns. Whether it's saving money, getting ready to retire, or discussing insurance, it's his objective to help his clients prepare for whatever may happen in their lives. Ultimately, he works with his clients as a resource to fulfill their needs and expectations. His own agenda is not a part of that. He's committed to his practice. Recently, he was awarded the #1 financial services representative in the country for 2 consecutive years, otherwise always finishing within the top 1 percentile. He's been published as a columnist regarding financial matters. Outside of his professional work, he was nationally recognized for his involvement in the community. The Building Blocks Foundation is a nonprofit he started that serves the homeless youth attending New York City public schools. That's wonderful. And again, welcome, Jay.
Hi, thank you very much for the warm welcome, Elizabeth. I want to thank everyone for attending in today's webinar. Elizabeth and I were talking before it started that this is such a relevant, especially in the past 2 days. We've seen the market take significant dips on new concerns over the coronavirus. We have countries, France, who's going into a 4-week lockdown. We have cities like Chicago that are pulling back. All over Europe, we're seeing significant increases in the coronavirus. The United States tends to be about 3 weeks behind them. So there are definite concerns with the coronavirus. It's definitely affecting the market and investors' confidence. And we're seeing that across the board. That confidence is weakening, and even in defensive type of investments where people typically run to in order to avoid from losing money, we see those in decline as well. And that's just indicative that institutional investors and people who generally invest are taking precautionary measures to protect their money. I won't go as far as saying that it's a reason to be concerned or to be fearful. And I don't think people should be running and liquidating their portfolios. I think it's very important, and what we're going to cover today is I think it's very important in understanding who you are as an investor and what's important to you. There's always 2 sides to the coin. So you have the fear factor where people are running and selling securities because they're afraid they're going to lose value. And then you have other people that are stockpiling their cash and waiting to buy in. I know when the market dipped back in March, we saw a significant March 24th. We saw a significant low in the market. And I know that myself included, a lot of people bought into the market at that time because everything was inexpensive. And we'll talk more about timing the market and et cetera later on. So I just hope that everybody gets something out of today's conversation. Understand that this conversation is just that, it's a conversation. By no means is it a recommendation for anybody to take action. That should be done one-on-one. I am certainly welcoming anyone who wishes to have a one-on-one conversation about your situation to reach out to me directly. If you already work with a financial planner or a financial advisor, then I would recommend you speak to them. Also, your attorneys and tax advisors are important to consult when making financial decisions. So with
And
that
Jay,
being,
I will be sharing your contact information in the chat function and in the follow-up email so that everyone will be able to have it.
great. And you all will get a tool that I promised everyone to help determine what type of investor you are, that maybe help yourselves out. So without further ado, let's see here. There we go. So, you know, prior to this presentation, you know, was talking about what we saw over the springtime. And as we got into the summer, late summer, August, September, I started to feel that maybe this was a little bit old news, but here we are again. And anxiety over not only coronavirus, but anxiety over the election is really setting in, and we're seeing some extreme volatility in the market. I'm looking now, and the Dow is down 800 points. Gold is down, everything is down. So there's certainly uncertainty in the markets. And so how do we address these? So we're going to talk about the overall view of the current market, which we kind of talked a little bit about. We're going to talk about market volatility, and we're going to talk about how to be invested during markets that are volatile, because there are strategies in being invested in the market. So looking at this chart here, the S&P 500 is an index which contains 500 of largest companies. Standard & Poor's is what the S&P stands for. And this dates back to 2009. And I want you to kind of just understand that, you know, there are going to be circumstances that create volatility in the market. These circumstances can be politically based. They can be geographically based. It could be market. It can be business. You know, we're looking back in 2009, post financial crisis, where we had the Great Recession. The S&P went down to one of the lowest points we've seen in a long time. You know, and then we see that the market kind of creeps up, right? If you look at 2009 to today, there's no doubt that the market is a lot higher than we were in 2009. So despite all of these things that have happened, all these milestones, presidential elections, the U.S. credit, the federal government credit was downgraded, means that, you know, they weren't as creditworthy as they were before. The Chinese stock market, all of these things that have happened have created dips. But overall, we've seen an increase. And why that's important is because when you understand what you're investing for and how long you have, you can determine whether or not you can withstand this volatility. Because at the end of the day, you realize that 10 years later, 20 years later, you should be in a better position than where you are today, despite all the volatility. So these are some factors and events that influence the market volatility. We had in the late 80s, the Black Monday, the market crash. We have a question here, I think.
Yes.
Yes, we'll talk a little bit about that. And I can definitely address your question about annuities. If I don't talk on it, I could definitely address that. So early 2000s, we had the dot-com bubble burst. We had September 11th, SARS outbreak, the corporate Enron scandal, the financial crisis in the 90s. So you see here that these are all things that have influenced extreme volatility in the market, and yet we ended up better than where we were prior to. So we talk about time horizon, and what's important to understand when you're dealing with market volatility is what is your time horizon? So let me give you an example. Time horizon, in addition to what are you saving for, right? So let's say you are 35 or 40 years old and you're saving for retirement, which is going to occur in 30 plus years or 20 plus years. Are you necessarily concerned with the volatility today? Because you're not going to retire until 20 years from now. So you have a time horizon where you could still withstand that volatility. There's an expression that I'll throw in here, and is, trying to time the stock market is like trying to catch a falling knife. Chances are you're going to get cut. You can't catch a falling knife, and you can't time the stock market. When the coronavirus first broke out in the beginning of the year, no one anticipated the rebound the market was going to have. Every analyst I spoke to or listened to or read about, they all said it was going to be an L-shaped recovery. In other words, the market went down and then it was going to kind of stay flat. No one expected that it was going to kind of come back up. In fact, that's what it did. I mean, the market regained, I know most of my portfolios gained about 20%, 24% since the downfall in March. So trying to time the market is very difficult. Understanding where you are as far as what your savings goals are is very key to knowing what you should do when you have volatile markets. So are you a short-term investor? A short-term investor is someone 1 to 4 years. If you're in 1 to 4 years, if you need money in 1 to 4 years, so if you're retiring in 1 to 4 years, or if you're saving money in a brokerage account and you're looking to make a major purchase such as a house, or you have children going to college in a short period of time, you really want to be in safety and or liquidity liquid type of accounts. That's cash or potentially even bonds, but you want to be somewhere safe. Midterm, 5 to 7 years, you want relative safety. You want some growth, but you want to be safe. So maybe cash, bonds, large capitalized stocks. Large capitalized stocks are your companies like Ford, Coca-Cola, Facebook, companies that, are established and they have a lot of money and a lot of strength behind them. Doesn't mean you can't lose money, but they're not as volatile as maybe some of the smarter startup companies or technology companies, internet type companies that just started out, etc. Your long-term investments, 8+ years, you have a greater risk versus reward potential. Again, because you have a longer period of time, you can withstand the in-between volatility. Now, that doesn't mean that you make or ignore your accounts. What it means is that you need to review your accounts and understand, the type of volatility that the market's experiencing and what's causing the volatility. Because, like everything, nothing is forever. Some things may take longer than others. Some may have a bigger impact than others. But, we're going to talk about timing, and you really need to understand, well, if I plan on retiring in 10 years, is, this election coming up in November going to affect my retirement in 10 years? It may have a small impact in the upcoming months. It may not have no impact at all. But the 10 years from now, I don't know if I would be worried about this election necessarily if you're retiring in 10+ years, right? So this is why you need to understand what is important as far as.
I have a question for you, Jay.
Sure.
So, what do you recommend? Let's say that I am someone who's more of a long-term investor. Do you recommend that I kind of keep my eyes off my investments because the volatility is going to be there? Yeah. How do I deal with that, and how do I manage that, movement of the market, and still keep my long-term vision?
Yeah, great question. So the example I normally give clients is I ask them, would you buy a house? And I'm assuming everyone here lives somewhere in the Northeast. So let's say, would you buy a house in Arizona and leave your doors open and windows open and come back to New York and just leave your house in that position? If you did, you'd probably have anxiety on whether or not someone's going in the house, if it's raining out and the house is getting soaking wet, or are there animals getting in the house? So you don't want to completely ignore it. You certainly want to be prudent, and you want to understand your situation, and you want to understand what you can, what potential threats there are. So it's not something, if you have a long time horizon, I'm not going to say you want to ignore it. What I want to say is you don't want to be too emotional or over emotional. And I think that it's important that you understand where you are in your investments and what your time horizon is and what the effects can be. So I think it's important to be mindful but I don't think it's something to overreact to. Does that help answer the question?
Yeah, absolutely.
Right. So speaking to that, I don't know why there we go. So this is how the markets move, okay? If you follow this from left to right, you see that there's optimism. The markets are going up, everybody's optimistic. Then the market hits a point of euphoria where everything is great and people are like, I want to buy more because things are great. And then we start to see a little bit of a decline. And that's when fear starts to set in. And people are like, oh no, I'm in trouble. And then they hit the bottom and then they freak out and then they sell and they sell low. And then it returns back to optimism again. And so what this slide is indicative of is most people, right, buy high and sell low. And that's the complete opposite of where you want to be. I mentioned to you in the onset of this presentation that right now, is it an opportunity or is it a risk? Are the markets at risk right now for loss, or is there an opportunity to buy into the market where stocks are being undervalued because of other people's concerns? And, again, you can't time the market, but it's very important that when you're working with a professional and you understand it, or if you take time out yourself to understand this, understand where we are in the cycle. And also understand that even me, myself, as busy as I am working with clients and running my team, that I don't have all of the time to sit down and analyze companies and what they're doing for research and development and how their economics are. There are analysts out there that do that. And these analysts are generally way ahead of what the news is reporting and what the general public is doing. So by the time you see it, euphoria, and you think the markets are great, they may already see that something's coming up that is not so great. So the experts are making adjustments, right? And there's a big difference between, institutional and professional type of investors than, the people that get into investing by opening an E-Trade account or the do-it-yourselfers. The institutional folks, they have experts that can tell what's happening, and they're generally far ahead of where the media is and the general public is. And so when we see a lot of this volatility, to be quite frank, it's because a lot of people that don't have the expertise to invest get in and they start buying investments. They see something on the news, they freak out, and then they sell. And they buy and sell, buy and sell, buy and sell. And that creates a lot of the volatility. When we see, like we see today in the market, where we're seeing, institutional investors selling out, and we see sectors of the markets that are selling out, that's a clear indication that there is some concern over security in the market. But they've already seen it and they've already sold. And the reason why the market is down, because they've already sold. So they've already sold, the market's gone down. Now you watch the news, you freak out, and you sold at even a lower number. So that's why it's important that when you're doing investing and you're watching your investments, that you understand where it is in the cycle, right? And where there's opportunity and where maybe you missed opportunity and you need to wait for that opportunity to come again. So it's very important to understand you can't time the market. It's equally important to understand where the market is and where it may be heading. And the best way to do that is to either do the research or work with a professional who has the research done for you. So let's look at what the average rate of return has been through January of 1999 through December of 2018. Now, one of the key factors in this slide is inflation. Inflation is cost of goods, right? What gasoline costs, what milk costs, what insurance costs. Everything that medical inflation is 5%, education is 5%, but monetary inflation is calculated. The average was 2.17. Whenever we're doing financial planning and when we're planning for clients with money, we always use a factor of 3%. But what's important to understand is that when you're investing in the market, you're investing in the market primarily to keep pace with inflation or exceed inflation. Because if you have $100 today and you put that $100 under your mattress because you're afraid you're going to lose money if you invest it, well, chances are you're going to lose no matter what, because that $100 next year will be worth $97. So you'll be able to buy $97 worth of goods next year with that $100 bill. Why? Because your $100 bill went to sleep while inflation moved forward. So cost of goods got more expensive. Now, is that to say that every single year you're going to have a 3% inflation? No, there's no way you can predict that. However, the reason why we use 3% is since 1929 until current times, the average rate of inflation was over 3%. It was about 3.2%, 3.27%. So 3% is kind of like the number that we use from financial planning. But this slide here shows you what the S&P index did, what the average stock fund investor did, what the bond market did, and what the average bond fund investor did, right? So what's important about this? The index is the index, right? There's 500 companies in the S&P 500, and whether or not the markets are efficient and whether or not we can predict and we can control how much money we make in loss, there are different theories on that. But this is to show that the average person who opens up an account online, invests in the money, and they performed at 3.88% between that near 20-year period. The market itself, with no manipulation, performed at 5.62%. So that just goes to show you that if you try to manipulate your investments during the market and what happens over a long period of time, chances are you're not going to succeed as well as the market would have done. The same thing for those looking at bonds. The bonds was a significant factor. The bond market or the index, if you will, performed at 4.55. It did its job. It outperformed inflation, which is 2.17. So if you invested money, the money you invest today in 20 years would be able to buy you the same amount of goods at the same price, relatively speaking to time. But look at the person who tried to do it on their own, right? 0.22%. So they fell short. So they basically lost 2% purchasing power. And that's what this is, purchasing power. Inflation, it affects your ability to purchase things in the future. So investing in the market is important because you want to outpace what inflation does for you.
And I like, again, that you mentioned there about how emotional investing can lead to long-term underperformance. Again, it's really about, working with someone that you can trust, making decisions, and then taking your emotions out of it.
That's right. Absolutely. Absolutely. It's important. And let me tell you that it's hard not to be emotional when your money's at stake. And, to your point earlier, Elizabeth, that question you asked, do you just ignore it? I think it's impossible for anybody to just ignore the potential risk and loss of money. And that for that sake, it's also helpful when you work with somebody else. I myself, although I'm very capable of managing and investing my own money, and I do it for my clients all the time, I have a buffer. I use someone who I trust, because when I'm going to make a decision on whether to buy or sell or make a move, I may be emotional because that's my money at stake, right? So we're all emotional when it comes to our money at stake. So it's important to put that buffer in place. So clients that I work with, of course, my phone has been going crazy yesterday and today, and people are worried about making changes. And then we just talk it through and we rationalize what makes better sense. What can change, and et cetera. So it's important not to be emotional. So let's look at the Dow Jones. Dow Jones is one of the larger indexes that you hear about on TV. Let's look at the type of decline, the magnitude, and how often they happen. Okay. So a pullback is 5 to 10%. We see that happen approximately three times a year. A market correction, we see 10 to 20% change down, right? And that happens about one time a year. Now, a bear market, and now keep this in mind, this is between 1900 and 2020, so almost 120 years, right? We'd say a bear market is 20% more, and that happens once every 4 years. Well, guess what? We haven't really seen a bear market in over 10 years. So we're on the longest stretch of a bull market where we've seen inclines, since the Great Recession. We've been in a bear market. So it doesn't mean that it's going to happen every 4 years. Just understand that it's anticipated to happen, about that time frame. So when you're looking at what's my time horizon, well, we look at it and say, okay, well, if you have a 4-year time horizon, chances are you may see a bear market where there can be a 20% correction. And this is why when we're allocating clients' portfolios or doing investments, we kind of look at the time horizon to determine how much risk and what type of portfolio we should put them in. And this is what you want to look at. So again, let's look at the bull and the bear markets. The bull and bear markets, those are, for those of you that don't know, I don't mean to insult anybody's intelligence here, but a bull market means that the market is going up, right? Bear market means the market's going down or it's stale. But if we look at the sky blue, right, we'll see that bull markets on an average have been 14 times stronger in magnitude and last 8 times longer than bear markets. So if we look at what the red is as opposed to the sky blue, okay, we are going to suffer some losses. We are going to have down times, and you are going to lose money in your portfolio. But if history repeats itself, which there are no guarantees, but if history repeats itself, you're going to see more inclines than you do declines. You just can't get emotional. For those people in 2008 that lost a significant amount of money, the people who really suffered are the people that sold their investments when they lost all that money. The common theme was my 401k is now a 201k. Right now, if you've lost money in the market and you sell, well, guess what? You don't have a chance to come back because you've sold out. So if I own a stock and that value went down and I sold it, well, I've accepted those losses. I either have to buy back in the market or, I lose out on the opportunity. If I buy back in, then I can ride the stock market back up. But again, trying to time the market is like catching a falling knife. But the color coordination on this slide, I think, is really good because it kind of gives you an indication of what we've seen as far as bear markets, losses in the market, as opposed to what we've seen in inclines and growth in the market. So when you're investing, one of the disciplines called dollar cost averaging. Dollar cost averaging is a great tool, and I often recommend it to my clients. The best way I can explain it to you is if you were to buy gas over a period of time in your vehicle, gas prices fluctuate quite frequently. Gas prices can fluctuate as you drive down the street. If I drive down a main road, I live in New Jersey, and if I drive, up and down Route 17, there's a ton of gas stations, and almost every one of them have a different gas price. Well, if I were to put a gallon in at each gas tank, at each gas station, I probably would pay less per gallon of gas when I filled my car because I paid higher, lower, higher, lower, higher, lower, versus if I paid, and at different times, versus if I just went in at one time and filled my tank. If I fill my tank today, I'm paying this much. Well, if gas goes down tomorrow, I overpaid for gas because I paid this much for gas today. Now the price is here. I lost the difference between what I paid yesterday and what the price is today. And the price may be here the next day and then back up. So when we're doing disciplined investing, it's wise to do what they call dollar cost averaging. And that often will help you with the volatility because maybe you buy a little bit now when the market's low. You buy a little bit when it's high. And it's going to help take the emotion out because you know that you're going to win some and you're going to lose some, but overall you should come out ahead. One keynote that's on here is that it doesn't guarantee you profits or protection against loss. It's just a strategy that has been helpful when, making or buying investments. It's a very disciplined way of being an investor. The S&P 500, we showed you the Dow a little while ago. Here's the S&P 500, pretty much from the Great Depression till today. The blue indicate the gains. The red indicate the declines. Let's look at, if you would put your attention to towards the right of the screen between 2005 and 2010, more modern times, right? If you look at what the S&P did in 2008, down 35%, look what it did afterwards. Look at the substantial growth. We've seen a little bit of a pullback in 2019, but then, or 2018, and then look at the substantial growth again. So again, if you sold out when the market was down at 35%, when the S&P was down at 35%, if you sold out in 2008, you lost out on all that growth that came back, significant growth. This is important to understand. So when you hear the hype in the media and people freaking out, you got to know what your time horizon is and know what your goals are, because you can make a bad decision. Here's another slide. It's talking about if you missed days, okay? So this slide here explains that if you had $10,000 in the S&P 500 in January of 1999 up until the end of last year, if you stayed fully invested from January of 99, and think about what happened then, we had the dot-com bubble and all those things, we had the Great Recession, all of those things. If you had $10,000 invested and left it alone, you would have made 6% overall return. Your $10,000 would be worth $32,000. Okay. If you missed the 10 best days in the market over that 20-year period, just missing 10 days out of the market because you sold, because maybe you were scared or you thought it was maybe time to get out. If you missed 10 days, you lost a significant amount, almost 50% or more of that portfolio growth, and you only seen a 2.44%. You barely beat inflation. If you miss 20 days out of the market, if you sold today because you're paranoid and you sold all your stocks today and you didn't come back in, right, and you missed 20 of the best days, then you would have a growth of less than 1%. And that means that those people that fits, they're under inflation. So their money's buying them less than what their money was worth when they first started investing in 1999. And then if you miss 30 days, look at that. I mean, that's sad. If you miss 30 days of the best days in the S&P 500, your value of $10,000 today will be $64.90. So again, it's all about being a disciplined investor and knowing when to sell, when to hold, etc. And I just want to say,
this is a wow slide.
yeah. I just want to say that, you know, this is not a recommendation for anybody to hold investments or sell investments based upon the market conditions that we're currently in, etc. This is to alert you to be cognitive of what your goals are and, you know, what your time horizon is. This is what this is for. Again, driving home, we talked about these events. This is the growth. Black Monday in the 80s, we saw a 20% loss. 5 years later, up 84%. The dot-com bubble, 43% loss. Whoops, sorry. And then 5 years later, it was up to 95%. The Great Recession, we talked about that. The Great Recession, 54% down. 5 years later, 177% growth. So when we're talking about those people that sold out in 2008 and they put their money in cash because they were afraid that their retirement tanked, 1 year later, they would have made back 69%. 3 years later, over 100%. 5 years later, 5 years is quick. 5 years later, 177%. So again, just count, we're pounding this theory that you can't time the market and you have to know where you're investing for. So what type of investments or what should you consider, right? So quality investments, you're gonna be able to, I'm gonna provide everybody a tool to be able to understand what your risk tolerance is. And that's most important. Like, what's your pain points, right? If you gamble on the casino, how much are you willing to gamble and how much are you willing to lose before you pick up the chips and go home? Likewise, how much are you willing to gamble and win and know when to take your winnings home and be happy, right? I think it was Kenny Rogers that sang a song, you got to know when to fold them, know when to hold them. And so it's important to understand what your risk tolerance is, what's your pain point, your time horizon, and what your investment goals are specifically, because there are different investment goals that's going to affect your decision-making. Asset allocation. You know, we're going to talk now more about the types of investments. Asset allocation, diversifying your portfolio. You know, there are so many different types of assets out there that you can invest in with different purposes that are affected by different circumstances that happen around them. But allocating your assets appropriately. Diversification. You know, in addition to time horizon, you know, a big thing is diversifying your portfolio. And so many people are not truly diversified. You know, they have an IRA or they have a 401k, maybe they have a brokerage account someplace. and they have an investment that has one name, and yet there's an investment with a different name, but they don't know what the underlying investments are in there. 401ks are notorious for having mutual funds in it. IRAs have mutual funds in it. There are many different mutual fund companies that may have the same type of objective. But if you have a 401k and an IRA and maybe a brokerage account, and they all have mutual funds in it, and they all have growth type of mutual funds in it, you could have 3 separate accounts with the same investments in all 3, but with 3 different names, and you feel you're diversified. So oftentimes we see that people are not properly allocated with their assets, the type of assets that they own, and they don't have the diversification. And when I talk about types of assets, we're talking about stocks, bonds, cash, things of that nature, real estate. There are different types of assets to own. So this is a good slide to give you a color coordinated or visual, if you will, of how things move around, right? Let's just take a look at the dark blue square. The dark blue square are small cap value stocks, small capitalization, small companies, okay? Usually you'll find those on the Russell 2000, which is an index. But in 2008, look at where they were at, right? They were at they had negative 28% returns. Look at 2009. They did pretty good. 2010, pretty good. 2011, not so good. And you see that blue square bouncing all over the place, right? And so over the 10-year period, do you stay in that asset allocation or do you move? It all depends on what your time horizon is. But this is to show you, when we talk about your 401k, do you just ignore it? Well, you don't necessarily just ignore it, because this is what's happening with your investments. If you have a mutual fund that is, let's just say one of these colored squares, whether it's a small cap growth stock or value cap or international, the mint color green are international stocks, right? You see the volatility there. The ups and downs, that's volatility. So you want to be cognitive of it, but this is just a good indication of how volatility works. This is the fixed income. These are bonds, right? People generally run to bonds for safety, generally run to bonds protected. Your portfolio usually consists of some equities, which are stocks, and some bonds. And the ratio really reflects, how much risk you're willing to take. But the same principle here. So as I was just talking about the ratio, right? So depending on how much risk you're willing to take, you may see when you pick out mutual funds, or if you pick out a portfolio, or you speak to an investment advisor, they may say, well, you want to be 60% equities, 40% bonds, you want to be 80-20. It used to be that when you were younger, you had a longer time horizon, you'd have very little bonds, mostly equities, and then there'd be kind of like a shift. As you got older, you'd have higher bonds, lower equities. Bonds used to be a flight to safety. Typically, when the equities market was looking to do poorly, everybody would run to bonds. And because bonds have guarantees of your premium, they have usually some kind of payment associated with it, and you're lending people money when you buy a bond. A bond is you're lending either government's money, you're lending municipalities or corporations, you're lending them money. And so there's usually some kind of interest rate payment back, right? There is interest rate risk there. So if you're expecting interest rates to go up, well, obviously if interest rates are going up, that means the economy is kind of in a boom. But the reality is that whole philosophy is being challenged right now, because we haven't really seen the bonds react to equities the way it has in the past. They've been kind of acting in sync with one another, where equities go down, bonds go down, equities go up, bonds go up, which is really not the way they normally work. So, like anything else, there's no crystal ball, but customarily, when you're building an asset allocation, you want to have so much in bonds and so much in stocks, and that kind of helps you to protect it. The one thing about that is that, and when we're talking about your 401k and talking about ignoring it, right? When you create a asset allocation, and let's say you have a 60-40 allocation where you're 60% stocks and 40% bonds. Well, that's great to start off with today, but you're going to get growth and you're going to have a certain amount of income coming in. And what happens is if you're reinvesting those monies, if your stocks are earning money or they're growing and you're reinvesting money, well, you could be buying additional equities. And if your bonds are not doing so well, maybe you're not buying as many bonds. And what you start to see is that your equity position starts to grow and your bond position starts to diminish based upon your overall portfolio. So if you started out with 100,000 and you had 60,000 in stocks and 40,000 in bonds, but now your stocks appreciated and now your total account value is $110,000 and you have $70,000 in stocks and $40,000 in bonds, well, you're no longer at that 60-40. So another reason why you can't just, set it and forget it is that you want to make sure you're maintaining that discipline in that asset allocation. You want to make sure that you're maintaining what your risk tolerance and your risk profile calls for. So if you are a 60-40 investor, you may have to rebalance your portfolio. You may have to sell some equities and buy more bonds to keep you at that 60-40, whatever the ratio is. But this slide just goes to show you over time, how that can get out of control depending on, the performance of stocks. So this just goes to show you all equities. If you had a hypothetical growth of $10,000 in all equities, what you would see as far as growth is concerned over, different periods and areas that the market were affected by the dot-com bubble, the recession, etc. So what's important to know about this is that if you were in all equities, okay, on a $10,000 during the Great Recession, you lost 54%, okay? But if you had a 60-40 blend, you only lost 33%. So that's what's important to understand about this slide. The slide is showing you how important it is to adding fixed income and allocating your assets appropriately, okay? Where if you're all equities, you stand a greater chance at loss. So even though you still would have lost money having a diversified portfolio, you wouldn't have lost as much. You would have saved 20% returns during the Great Recession had you had an asset allocation mix. I saw some questions. Were there questions to be asked?
Yeah, we have a couple questions here. One is, with the market moving 1 to 2% daily recently, what would trigger the rebalancing? Quarterly percent move, etc.
Rebalancing for who?
Jeffrey, would you like to tell us what would trigger the rebalancing?
Are you talking about your own portfolio? Or are you talking about the government? I mean, what do you mean by what would trigger? What I'll say to you is this: the government, if you're talking about interest rates and things of that nature, the government has different ways that they can control inflation and growth. Interest rates are low right now. They don't anticipate any change in interest rates. But obviously, monetary policy, if I have a 64 and it moves, so if it moves to 50-50. Yeah, so I mean, again, it's time horizon, right? So if you have a time horizon of 20 years, you have an agreement. When you work with a financial professional, there should be some, you should have like a period, like my clients in the agreement that we have, we talk however often we agree in the agreement. So whether it's quarterly, monthly, semi-annual, annual, we do a review. And then, it's hard to say, but is it a hard fast, oh, you fell out, we should definitely switch? We're not going to say that, today you're at 50-50 because tomorrow you may be at 40-60 or 60-40. So, you want to kind of see once there's a significant during a review, there's no hard fast, okay, now's the time to make a change. The key factor is that right now there's a lot of volatility in the market. So if you're overweighted in equities and there's a lot of volatility in the market, it may be a good time to shift some allocation. But with that being said, bonds are not doing that great either. So it's like, where's the run to safety? So that's when the time horizon comes into play. It's so hard to diagnose, but it really depends on the individual's needs, risks, and objectives. So it is really an individual thing. And I hope that answers your question, but it's really hard to say exactly when you rebalance it because I don't know when, you need the money, et cetera.
Jeffrey did say thank you. And then
But
we
you're
have,
welcome.
and then we have another question from Lee, who wanted to know, what do you think about target date funds for an employee 401k plan?
Yeah, that's a phenomenal question. So just exactly what I was talking about as far as automatic rebalancing, that's what target date funds do. Target date funds provide an automatic rebalancing. So as you are younger working, then they're investing, in more aggressive type of positions. So they're mostly in equities when you're younger. As you get older, that shifts, right? So they may be an 80-20. And then as you get older, because a target date fund, let's say if you have a target date fund of 2060, well, that's 40 years from now, right? So you're going to be very aggressive. And as you get closer, it's going to move. But if you're a target date fund 2025 or 2030, then it's going to be much more conservative. And therefore, because they know you need the money sooner. Target date funds are good. It's kind of like, they're expensive. Most people don't realize that in 401ks, there are expenses. People think about investing and paying money. 401ks are expensive for employers to operate. There is still management fees that are paid and all kinds of fees that are paid. You just don't really realize it because they take them out in little increments. But some employers pay all of it. Some employers pay none of it. It just depends. I set up 401ks for businesses oftentimes, and it's up to the employer who's going to pay for them. So, buying a target date fund could be very expensive, but from a discipline, and if that's all you have, or if you have that, it's either buy a target date fund and take what they give you, or you try to diversify your portfolio and rebalance your portfolio. Again, it's really challenging to do. It's kind of like, diagnosing yourself and treating yourself medically. If anybody reads WebMD, a splinter may lead to cancer and ultimate death. So, I mean, we could all get freaked out by things we read. So it's challenging, but target date funds are a good tool for people who don't want any responsibility and they just want to buy what they have or put money in a 401k and let them manage it for them.
Great, thank you. Another question from Nicholas wanted to know about the stock market impact of a Trump win versus a Biden win, and if you're allowed to speak about that.
Here's the thing. This industry is still the hypocrites, and I've come to that realization. And the reality is, no one knows. Okay, it's all hypothetical. When as a professional, I read, listen as much as I possibly can. I try to filter as much as I possibly can. The problem is that, so many portals have gotten their own agenda and the propaganda out there. They position the information to meet their agenda. So it's very, very hard to dictate. What I will say, though, the general consensus is, risk in the market, when we talk about institutional investors, large, investors, banks, countries, things of that nature, they price these things in. So if there's some thought that the market has already responded a while ago to what that potential is, there are going to be things like, a spike in Corona, France announcing yesterday that it's closing for 4 weeks. These things could put fear in, and you see people run to safety. To answer your question, Trump versus Biden, it depends on who you are, right? It depends on what your beliefs are. You're either a Trump believer and believe he's good. You're a Biden believer, you believe he's good. If you believe in the politics of Biden, you believe in the politics of Trump. I mean, there are other outside things that are there, right? What's going to happen? Will Trump actually accept the loss if he loses? Is Biden? I mean, there's so many factors. And so no one really knows what's going to happen. I would never gamble on that. What I would say is that it's always important to know, and I keep saying this, and I hate to sound like a broken record, but it's important to know what you're investing in and how long you're invested for. Because if, again, you're retiring in 15, 20 years, who cares about this election, right? Don't try to time the market, just stay the course. And that's really the objective. So if you're retiring or you need money soon, or your savings plan has a short term, then, you know, maybe we talk about it and say, well, yeah, I think I should be more conservative than where I'm at now. So, and I hope that answers your question. I know I can't give you like a crystal ball. And unfortunately, you know, that's just false hope. So, and I don't get into politics.
I have one more question from Shakira. She wants to know, is fixed income synonymous with bonds?
Yes and no. Bonds typically provide a fixed income. Different types, but there are bonds that provide no income, like zero coupon bonds and things of that nature. And also there are other types of investments that provide fixed income, such as annuities. So yes and no. There are other things that provide fixed income. So I'm hesitant to say that they're synonymous 100%. When people talk about fixed income instruments, bonds is definitely a consideration, but not all bonds pay an income. You can still lose money in bonds because, you know, when the bond term is up, it's just like any other note. When you have a 30-year mortgage, it's like buying, you know, the company basically lending you a 30 or creating a 30-year bond with you, where you're paying the company an interest rate and you're paying them a premium every single month. You know, unlike bonds pay, you know, either semi-annual or annual, but it's the exact opposite, where if you're lending somebody money, they're going to pay you an interest payment, you know, for that money you're lending them. But if interest rates go up, then the price of the bonds go down. If interest rates go down, the price of the bonds go up. But when that time comes, when that 30-year comes, or 10 years come, or 20-year comes, or whatever the duration of the bond is, the value of that bond could be, you know, higher or less when you try to sell it based upon what the, you know, whatever's happening with interest rates. So, but yes, bonds are a form of fixed income, but not only bonds. All right, you're welcome. So again, with fixed income, let's look at this portfolio here. We talked about what an all equity portfolio would have done. Again, an all bond income, okay? Someone that had all bonds. Wait a minute, let me see something real quick. All equity, okay. All bonds, okay. So this is just going to show you here that, again, the performance of all bonds, right? The gold, having a 60-40 versus all bonds, again, having a diversified portfolio would outperform all bonds. Okay, so if someone ran to safety because they were afraid of it, they would have been better off if they had an allocation. So let's talk about the key takeaways. And I promised annuities, and we'll talk about annuities. That person that asked about annuities, please, you know, type your question in so I can answer them. I can speak to a lot of things about annuities, and we have a little bit of time. But some key takeaways from today's presentation, right? First and foremost, don't be emotional, right? The way you're not emotional is by dealing with it professionally and working with someone who can help you understand. Don't ignore it. Procrastinating or ignoring it or pretending it doesn't exist will just create anxiety and cause you to be emotional. Focus on the long term. You know why you're invested. Understand that what your goals are. If you're planning for retirement, you know, don't worry about the bump in the road today. Don't worry about what may happen 3 years from now, because if you don't do anything at all, or if you're too protected, being out of the market, we already told you, or we already talked about how you're gonna lose regardless. Invest regularly. You know, understand that you know, whether it's good or bad, investing regularly will give you opportunities when the market's low, and you know, you may not get so great opportunities when they're high, but you know, it's not like your 401k, right? You're not going to call your employers tomorrow and stop contributing to your 401k because the market's down. You know, when the market's up, you don't stop contributing in your 401k because the market's up. You just steady course, right? That's what you got to do. Diversification, you know, diversify your assets, understand what you're invested in, understand that a name difference doesn't mean you're diversified, just means that there's just a different name on it. Here's the other thing I'm going to talk about diversification real quick. Is not only is asset allocation important with diversification, but the type of account you have is diversification. Because one thing we didn't talk about today, and I don't want to get too much into, is taxation, but understanding what money is taxable. Tax today, tax tomorrow, tax never. It's not what you make, it's what you keep. So understand that diversifying your portfolio not only means choosing, an array of investments to help protect from volatility, but also, at the end of the day, when you need your money, how are you going to get that money? Is it 100% taxable? Is it some, that you're not going to pay tax on? But that's a big factor because taxes in itself are a variable, right? Consider the stock market goes up and down. Well, what happens with taxes? They go up and down. In the 70s, the highest tax bracket was 94%. 94%. You made $100, you paid $94 in taxes. Right now, we're in a historical low. So 37.5%, if you're making a lot of money, is the top tax bracket, not including state or city if you live in a city with city tax. But that's a significant difference from the 70s, right? So understanding that taxes move as well. So if you're saving for retirement and we're in a low tax environment and you retire and we're in a much higher tax environment, I got bad news for you. A lot of that growth that you earn during that retirement savings period is going to go pay taxes, right? So it could definitely alter what your future goal is. So that's also an important part of diversification. And rebalancing your portfolio. Again, understanding who you are as an investor, understanding how you should be invested based upon who you are as an investor, what your risk tolerances are, what your time horizon is, and being disciplined and maintaining that ratio is ultimately important. So with that being said, I'll open up to questions. I know I owe somebody some information on annuities, so please feel free to ask about the annuities.
Yes, please ask your questions. We had some great questions throughout the presentation. And if you have some more questions, we're here to answer them. Do take advantage of this great opportunity. You also will be able to reach out to Jay after this as well.
I think, there's a question about today's recording. I think it's available on the Schneps Media site. And I think there's a link to that.
Yep, it will be available on the Schneps Media YouTube channel. And that will be available in 48 hours. And as soon as we get it, we'll send it out as well. Okay. I'm putting here in the chat Jay's contact information, so you can reach him and ask your more specific questions. So Jeffrey did say that he didn't have anything in particular about annuities, but he was looking forward to your discussion about annuities.
Well, I'll talk about them real quick. So, and just because they are an important part of this, annuities offer, a couple of benefits. Number one, they offer deferred growth. So that means that if we just talked about diversifying taxable income or diversifying taxes, when you have investments, some investments, if they're not retirement investments, you can receive annual tax because of capital gains and growth and things of that nature. So annuities allow for taxes to be deferred. In other words, you don't pay taxes as the annuity grows. However, annuities, you have to wait till you're 59 and a half to take the money out. So there's, if you have a retirement account, and it may or may not make sense to go into annuities. There are a lot of type of annuities. There are a lot of people who downplay annuities. And what I will say is that, like automobiles, annuities are products, just like an automobile is. And companies come out with new types of annuities all the time. There are some fantastic annuities out there to provide for guarantees that other investments can't provide for. One thing I'll share with you is annuities typically offer a death benefit. So if I give an annuity company $100,000 in an annuity to grow it, and the market goes down to $80,000, I could get my family, and I died, my family most times will be guaranteed the $100,000. I can't say for all annuity companies because there are some differences, but the majority of an annuity is a life insurance. And keep that in mind. That's why only life insurance companies can sell annuities, because it's a life insurance contract. If you don't take any money out of that annuity and you die, your family gets what you at least put into that annuity. That's one key benefit. So if you retire with a 401k, you put into an annuity, the market tanks and loses tens of thousands of dollars, and the next day, unfortunately, you die, your family doesn't lose what the market lost. They get that money that you put in. So that's one benefit to an annuity. But there are downsides to it. You know, there are surrender charges, there are expenses. But one thing about this is that whenever considering your investment type, it's important to know what you need the money for. Annuities can be a great product. They can be a nightmare product. It really depends on what your needs are. But what I would say is this: investing in general, anything in general, don't do what your friends do. Don't do what your neighbors do. Don't do what your coworkers do. Understand what your situation is and do what you need to do. So many people say, I did this because so-and-so at work does this, or my cousin did this, or my brother did this. In 20 something years, I've never met a client the same as another client. I've never met two people the same. Okay. So with that being said, Liz, do we have some last minute questions I can answer?
Yeah, we have one more question I'd like to get to. First of all, we did get a comment. Someone said that they love your honesty and it's a real pleasant change. So I wanted to pass that on to you. But let's do one more question before we have to say goodbye. And that is from Laura. She wants to know, if I have an IRA which hasn't surrendered yet, does it make sense to cash out and get an IRA Roth instead?
I don't think IRAs surrender. I don't know what that means, but what I would say is this. So when we're talking about tax diversification, I love Roth products if you qualify. Not everybody qualifies, and there's other ways to kind of get the same benefits without qualifying, but that's another story. And it's a legal way. I'm not telling anybody there's illegal ways to do things. But if you have an IRA and you're wanting to convert it to a Roth IRA, right? So if you're young and you're contributing to an IRA and you don't necessarily need the deduction today, you know, it may behoove you to grow that money, basically tax deferred, and get all of that growth. If I invest $10,000 today and I'm 20 years old and that market's and I put that in a Roth, right? Let's just say hypothetically, you can only do $6,000 a year, but let's say I move $10,000 into a Roth and I'm 20 years old and I let that grow for 45 years. There's going to be a significant amount of growth, assuming that the market does what it does. There's going to be a significant amount of growth. So you put the money in at 5 years ago, and now you're 59. So the real answer to your question, Laura, is can you afford the taxes today? If you have a $100,000 IRA and you want to convert it to a Roth, you're going to pay income tax on $100,000. Now, if you don't need income from that Roth IRA and you're going to defer that growth, well, you have to ask yourself, if you think taxes are going to go up, so if you're at a 28% tax bracket, hypothetically speaking, and you're of the belief that taxes are going to go up, well, do you want to pay taxes today rather and have a tax-free income later on? Or do you want to risk, you know, potentially, you know, paying a higher tax later on? So if you're at a 22%, 28% today, and taxes go up to 40% when you actually need the money, let's say in 7 years, normal retirement, then, you know, you could potentially be paying a much higher tax rate and get a lot less income out. So there's no crystal ball. We don't know where it's going to go. The question is, what's your comfort level? If you want to know what you have in your account and not have to worry about what taxes are going to do to your portfolio when you retire, and then while you are retired, because you can be retired for 30 years, then if you can afford the tax today, it may behoove you to pay the tax today and put it into a Roth IRA, continue to grow on a tax deferred basis, and get all that money out tax-free when you retire. Keep in mind, when you do a conversion though, right, you have to wait 5 years before you can take that money out without problems. But certainly, Laura, you know, I can't give you specific advice as to your particular situation because there's a lot of things that go into that. We can talk about it. Just bear in mind, for generally speaking, making that decision to do a conversion, 2 considerations. 1, what do you think taxes are going to do in the future? 2, can I afford to pay the income taxes today? Great question, and I appreciate it. And Liz, I know we went over time, but I thank you very much for the opportunity.
Absolutely. Well worth it. Thank you so much, Jay, for this valuable information about investing in turbulent times. I know I learned a lot, and thank you, the attendees, for your participation and for being here with us this afternoon. You will get an email tomorrow with all of Jay's contact information, and this will be available. This recording will be available on the Schneps Media YouTube channel, and you will also be able to find Jay's previous webinar recordings there as well, so you can get more of his jewels of knowledge. But better yet, you can reach out right to him and have him discuss your specifics. Yeah. So don't miss out on that opportunity. Thanks, Jay, for being with us. Thank you all attendees. Please, everyone, stay safe, stay healthy, and have a great afternoon.
You guys will get the attachment emailed to you with the work piece to determine what type of investor you are. So I'll email that out to everyone in the next couple of days.
Yes, please keep an eye out for that.
Thank
Have
you.
a great afternoon, everybody. Bye-bye.
Thank you.